next discussion explores compelling investment opportunities across Indian equities, gold and precious metals, fine arts and collectibles, while examining the role diversification continues to play in today's markets. Please welcome Spike Hughes, founder and CEO of Cohesion Asset Management and Indian equity specialist. Henry Howard-Sneyd, honorary chairman of Sotheby's. He is a global titan in the art market. And Leonie McCann, head of multi-asset solutions at KeyBridge Asset Management, overseeing more than 130 billion in AUM. Please, Jamie, take it from here.
Thanks, Heather. Panelists, very, very warm welcome. Ladies and gentlemen, we move into a new phase here, different investment conversation. 3 asset classes, 3 different worlds. You might be asking why. Why did we put these 3 together? Well, we asked a group of single and multi-family offices where they were hearing commentary, what was the noise level, and these were the 3 asset classes they came up with. The 4th was actually Chinese equities, but I couldn't find a Chinese equity expert to match the trio of geniuses here, so China for another day. So 3 largely uncorrelated ideas for increased asset allocation, not just into your portfolio, but into your personal balance sheet if you don't run a portfolio. Or are they? So Indian equities, we know the case, structural growth. Gold and precious metals, we know the case, protection, scarcity, and resilience. Art and collectibles, we're interested in learning the case, but obviously provenance, cultural value. This is a discussion about portfolio construction, about conviction, diversification, and judgment. Why? Because the world has changed. Let me start with a central question to all 3 of you. If an investor, and there are plenty in the audience today, is looking at their portfolio or personal balance sheet and asking whether we should increase allocations, what in your view is the case for doing so? Leonie, we'll start with you, Spike, and then we'll come to you, Henry. Thank you.
So do you want me to start with gold, then precious metals? So I would absolutely see a case for having gold in a portfolio right now. And you've touched on some of the points there, Jamie. We are living in an increasingly multi-threat world, and there is just a broader range of potential outcomes out there. So when I come at things from an asset allocation perspective, from a multi-asset perspective, we're really trying to ensure that we can build a core resilience anchor in our portfolios. You want to be diversified, as you've said, and you want to diversify your diversifiers. And gold can play a core role in that. So we see gold as a key geopolitical hedge in your portfolio. We are in a new geopolitical era. We need additional assets to help protect against that. Gold obviously had a very strong run last year. It maybe hasn't provided that hedge you might expect in the Iran conflict, but it does offer a potentially more attractive entry price to gold than what you saw last year.
Thanks. Spike.
So let me start with the question, Jamie. Over the last 25 years, measured in US dollars, what's been the top performing market? Is it the S&P 500, Japan, China, world index, emerging markets? I hate to say, actually, the top 2 performing markets were Taiwan and Korea. But Taiwan was largely one company, and Korea was really a couple of chip makers, so really 2 countries heavily betting on the semiconductor trade. But next, behind them, and ahead of everything else, was India, even measured in dollars. So India today, 4th largest economy in the world, on track to be 3rd largest, fastest growing, amongst the lowest inflation, but a global allocation is typically no more than 1%. So I think that's the gap to close.
Well, Henry, do you want to comment?
Sure, I'll put in my penny's worth. I recognize that art is in many people's portfolios, and certainly the amounts of money you might have to spend to buy work is not inconsiderable. So of course you're paying attention to that. But I think we would generally argue that art is much more than a financial investment. And if you're considering putting money into art, you should be looking at the other returns that you get from it. There's the simple beauty of the objects, but I like to think of art as the summit of human achievement, the culture that we achieve. If we're all wiped out, Martians come to this planet, what are they going to see? They're going to see buildings. Well, they can build buildings. They're going to see spaceships and aeroplanes. They can do that. The art, the culture that we create is what they're going to see. So you're perhaps investing in something rather more than just financial return.
Thanks, Henry. Spike, that was a strong case for India there. Let me probe a little bit deeper. And Leonie, with your global coverage, you might want to comment as well. But the India story is compelling, okay? 9% for the last 10 years per annum. But there's a few questions about investing in India. They're asking valuation questions. They're asking governance questions. They're asking currency questions. The challenge of selecting the right route into India. Give us your thoughts.
So you should have invested with us because we did double the market returns. But no, picking on those three things, valuation first. This is one of the biggest growth stories in the world for the next 10, 20 years. So, of course, it's not going to be cheap. But if you look at India, if you measure India valuation against its long-term perspective, its own long-term average, it's not expensive today. But the market will always be skewed by a few index stocks which you don't need to own. There's much more value outside of that. I think on governance, I mean, that is a question we don't get asked so much these days. It used to be in the past. I think there's more corruption elsewhere in the world than there is in India today. Over the last 10, 12 years, Prime Minister Modi's done a fantastic job on cleaning up the country and transforming it and rooting out corruption issues. I'm far more worried about corruption in the US than I am in India today. But again, it's about what you own as opposed to should we own the asset class. And then the third one was currency. So I said, India, apart from Taiwan and Korea that have really been built on three companies, India's outperformed every major market in the world, even after currency depreciation, even after a global pandemic, global financial crisis measured in dollars. So I think that answers the currency question really. But the most important things for currency, if you've got high growth, low inflation, good fundamentals, your currency outlook will be good. So I think the biggest risk is not paying a premium for a big growth story. It's being underexposed to the world's fastest growing major economy.
Leonie, are you buying into that?
I'm going to interject here. So I agree with a lot of that story. That has been the case, but there has been a shift over really since the end of 2024. So if you went back really post that COVID period, yes, India's grown 7% annually on a yearly basis, one of the best performing regions in 2024. Since then, it has underperformed. And this year, if you look at India in local currency terms, it's down 4%. Broader emerging market equities are up 22%. Yes, a lot of that is Korea and Taiwan. But what are the two reasons for that? I'm going to mention the elephants in the room. The big one is AI and the potential AI disruption that poses for India. A lot of India's growth story has been on that being a global business outsourced service industry, and AI is a clear risk to that. The other issue is the conflict in Iran. Our view is that fog is lifting, which would be supportive in the near term for India. But I do think AI is the big elephant in the room when it comes to India. So I'd love to hear your perspective and thoughts there.
Yeah, no, thanks, Leonie. I'll try and think of a question for you in a minute. But
Do you two want to carry this on your own later?
I'll answer your question first. No, so I think everyone thinks that India is the anti-AI trade. And the reality is that this will be one of the biggest beneficiaries of AI adoption anywhere in the world, at scale, across hundreds of millions of people and hundreds of businesses. If you look at the last 2 years, foreigners have been the biggest sellers of India than they have been in the last 25 years. A major part of that, however, and last year it was tariffs, which has been resolved. This year has been Iran war and higher oil prices, which I would have said yesterday was largely resolved. I'm not sure today. From a structural growth perspective, I think India will still outperform. Year to date, we're 20-something percent ahead of the benchmark. That's been through good stock picking. So, there's lots of sectors and lots of companies that are doing very well. But I think the biggest reason for foreign selling and that negative sentiment does come down to the AI trade. 12 months ago, in June 25, and MSCI Emerging Markets, which is a benchmark for lots of people, as you know, is 1,200 companies at 24 countries. One company in Taiwan and 2 in Korea represent 30% of the entire emerging market index. That is as much as the whole of China and India stock markets combined, which are 2 of the top 5 stock markets in the world. And so India's weights come down from 20 to 10% in 12 months, and that's forced ETF rebalancing and selling. So I say that's the main reason. On the ground, I think the things are going from strength to strength.
Spike, thanks for that. And we'll just move along, but you can tell why this guy runs one of the greatest Indian boutiques in the world, Cohesion Asset Management. Just a shout out for another great boutique if you are looking at the sector. Leonie, I want to stay with you on something. For people in this room who may have the option to hold physical metals, funds, equity-linked structures, if they were buying into your thesis of going long precious metals, how do they hold it in your view?
So how we're holding it is via an ETF, so buying physical gold via an ETF. And the reason for that is it's the most efficient, liquid, easiest means to get that. But when it comes to how you invest in it, and this really applies to any asset class, it can be quite personalized. You need to think about your personal circumstances, how you operationally set up. You don't want to go through a long investment due diligence process to find out at the end point, okay, we're not operationally set up for that structure. It also matters on what are you trying to get by allocating to that asset class? From our perspective, we're looking to get that exposure to gold and use that as a hedge in our portfolios for geopolitical risk and diversification. If you're looking to maybe get exposure to maybe some of the more cyclical exposure of gold, maybe you want to invest in gold equities, so gold mining companies, and you're happy to take some of that equity beta. So I do think it can be quite nuanced and down to personal circumstances. But if you want direct, easy, liquid, efficient exposure to gold, we think ETFs or ETCs are pretty efficient.
Well, what about holding the physical and avoid all those management fees?
Well, you could do that, but it depends how much you're buying and how do you store that and what's the security of that. But you absolutely could. But it creates challenges.
Yeah, no, fair point. So Henry, let's come to you. Art and collectibles, they're different again. Don't behave like public equities. They don't value like bonds. They're not priced every second on the screen. They involve rarity, provenance, condition, taste, culture, history, global wealth. We could keep going. What about a buyer looks at art and collectibles? How should they think about the investment case, or just keep it as a passion asset?
That's a big, long question, and there are a lot of elements that do need to be thought about with collecting art. I will just pick up on something that Spike's saying about India, which is something that we've seen with emerging markets consistently, which is as a market rises, the art very soon will follow and tends to move very fast. So there's a moment as a country comes on stream in terms of its economies and starts to hit the news. The wealthy people in the country pile into their own culture very strongly. So in terms of looking for potential, there are a couple of countries that are obviously out there. For instance, Indonesia, that's huge and doesn't seem yet to have come. When it hits, it'll hit really hard. So an investment game might be just buy into the art of a country you think is going to come, and it'll take you somewhere.
Henry, that sounds a bit like let's follow the speculators. Is that what I'm hearing?
Yeah, I think in some cases it might be, yes, but equally, do the speculators always get it right? And so the art world, you have to be careful in
There's
that
a lot of
respect too.
investors in this room. Can you tell us where the speculators are heading in collectibles, please?
Well, the market that we've seen rise most dramatically in the last 2 or 3 years is India. Major collecting of Indian art. Works that used to be $1 million, $2 million US, now $10 million US consistently. So that has seen in 2 years, literally that jump. I was very much involved with China back in the early 2000s. That did exactly the same. I sold a piece in maybe 1995 for £20,000 in London. In 2006, we sold it for £10 million equivalent. So when the art market moves, it can move very fast. Is really the
Can I
message
drift
I'm
you
giving.
into just a little bit about collectibles? Not just art, rare books, classic cars, watches, wine, whiskey, coins, sports memorabilia. Come on, just give us a view from inside the auction house. You are the honorary chairman. Come on.
I wish I was the owner. I'm definitely not the owner. It does go across all the boards, but I think you like probably in the financial world, you want to balance your portfolio if you're looking long term, but you can jump in a speculative way very effectively if you know what's going on. The really big concern is that you do get the right thing and you are buying what you think you're buying. But I would say it goes across wine, it goes across watches, it goes across the whole
Market in
gamut.
second-hand handbags this year is 7 billion. It's going to 12 billion. Do you buy into that?
astonishing. Would I buy into that? No.
No, I didn't
Personally,
think
no.
so.
But
I might, yeah.
yeah, you might, exactly. My
All right,
wife
guys.
certainly does.
Guys, let me switch this up a bit. Okay, different angle, liquidity in each of your asset classes. I want you to think as thought leaders. Equity thought leader, I'd like you to think as gold, precious metals thought leader, and you in collectibles and art. Do you think your assets will end up being tokenized?
Shall I start?
Go for it.
Well, India already runs one of the most digitized countries in the world. 1.5 billion people, all on a digital platform. So there's certainly a place for this in India. Will be easy to adopt and a natural fit, I think. Certainly, where you have very illiquid assets, such as in your case or cases, I can really see the value of tokenization. And I know it's a big theme for the world. So yeah, I think certainly big place.
Okay, Leonie?
Yeah, I mean, I hate to mention the B word, but people think of Bitcoin as digital gold. I don't think it's that big a jump to think that you could tokenize gold. It's thinking about some of the earlier panels and some of the challenges around tokenization. Unlike some other traditional assets, gold doesn't deliver yield or tangible cash flow. So you wouldn't have that issue of trying to how do you pay out a yield or a dividend that only comes out at certain dates. More broadly, when you think about tokenization, it can, and it is exciting that it can apply to a lot of different assets. You're not changing the underlying asset, you're just putting a digital token on an asset that can then be put on a programmable ledger, which has lots of benefits. You can have fractional ownership, which maybe is a bit easier when you think about gold. You can melt a gold bar down and break it up. Maybe more challenging for some other assets. So yeah, I do think there's potential. But one of the points made earlier, I'd agree with that regulatory uncertainty. You're not changing the underlying asset. That legal and regulatory framework that applies to the asset still applies. And until you can bring and marry those two together, I think it's still a bit away.
Great answer. Henry, we all want to hear, can we real world assets tokenize them?
Well, you can't fractionalize a Van Gogh painting because if you cut it into little pieces, obviously, even if you put them back together, they're not going to be worth anything like they were before. I think that tokenization has been tried, but if we go back to my first comment, which is you're then missing the whole point of the work of art, which is you need to be able to see it, you need to be with it, you need to use it. And if it's tokenized, you're obviously not going close to it, and that would seem to me to miss the point.
Okay, fair enough. We're ready for a quiz. Serious prize. There's a serious prize coming, okay? And you're not allowed to look at your phone. You're not allowed to phone a friend. Okay, here's the quiz. Everybody see that okay? Henry sold this bowl. It's a Northern Song Dynasty paint washer bowl. How about that for a mouthful? Did he sell it for, hands up, 0 to 100? Hands up if you thought that. Nobody? 1. 100 to 5? 500 to 2.5 mil. Big prize, by the way, for the winners. 2.5, we did 2.5 to 5. Did we do that? Okay, 5 to 10. Henry, how much do you sell it for?
None of the above.
I know.
37 million. US dollars, yeah, that's the currency.
Why is it worth so much?
That's a statement of culture. This is considered to be the Mona Lisa of Chinese art. Very subtle, very sophisticated. I can see some bemused looks around the room as to why it should be something so special. But this is a representative of the finest moment of Chinese culture, the 12th century, when the emperor himself was considered a great artist as well. So to be in the art was the absolute apogee of a country that probably was the leading country in the world at that time. And they are exceptionally rare.
So you sold it for 37.
Yeah.
How much would you have sold it for when you started your career 30 years ago?
They're so rare that they don't come round, but I would think $1 million at most. So there's another one where the price jump is enormous because of the wealth of the Chinese collectors who have to have this object in their museum.
Okay, let me pick up on the uncorrelated point. and how do these assets, how do your assets that you're representing differ from the normal assets that represent a portfolio, either your own balance sheet or portfolios you manage? How do they? How are they uncorrelated? How about you go, Leonie, first?
Well, gold is unlike traditional assets for some of the reasons I already mentioned, that it doesn't have that tangible cash flow or yield. It's hard to find a valuation model to determine the price. You can't just think about what's the future value and discount it back. And that because of that, it does tend to have diversifying and uncorrelated benefits in a portfolio. It does come with a lot of volatility, though, as well. That's also its Achilles heel, as well as one of the benefits. So when you think about it, I always like to think of what it does in that broader portfolio context and what role it plays, because it can have quite a broad range of outcomes.
Nice. Spike?
So, well, historically in India, Indians save $1 trillion a year, and 60% of that was historically in property, but 12% in gold. And India is the biggest private owner of gold of any country in the world. And equities has been emerging. It was 2%, now it's 5%, and obviously that will grow over time. But my view on correlation and diversification, India is a diversification for portfolios. In the short term, every market is driven by noise and correlates quite closely. But in the medium to long term, things will be driven by their own fundamentals. So if you're taking a 10-year view, India will be driven by, the demographics, the improving productivity, the reform momentum. It's got its own fundamental structural drivers. It's not going to be determined by what's happening to a US semiconductor company or a Taiwanese semiconductor company. But in the short term, of course, things correlate.
Yeah, nice.
So you have to look at these things over years, not over weeks.
Okay. How many years?
3 to 5 plus.
Okay. Henry, your asset class, correlated or uncorrelated?
With what?
Well, when rich people get richer, do they buy more art?
Yes.
Okay.
Very, very correlated in that regard.
Okay.
You have to be rich and have that amount of money spare to put a large amount into a small brush washer like that.
Hey, what ruins your investment thesis, Henry?
Well, one of the thesis that it's a good investment is the issue of how much it costs to insure, look after, protect a piece during the time you hold it. It doesn't earn you any money at all, and the transaction costs are quite high. There's a group called the Fine Art Fund, set up 4 or 5 funds maybe 20, 30 years ago, and they declare a gross 15% per annum compound growth, but they say they won't tell you what the costs were, because that obviously will knock that down a lot.
Okay, Leonie?
What would ruin gold's case from here? Well, gold tends to do badly if real and nominal rates are higher. So if you were to see an environment where real and nominal rates are higher, its property as a hedge is going to fail. And that's part of the reason why gold didn't do as well in the Iranian conflict in the Middle East, that as well as people were taking profit in very strong performing assets from the year before. But again, it comes back, and we keep talking about diversification and the role in a portfolio. I always think diversification means that there's always something in your portfolio that you have to explain, because not everything is going to work at the same time. You don't want it to, because otherwise you don't have real diversification. So there can be periods where it won't work, and I think a higher rate environment would see some struggles for gold as a geopolitical hedge.
I'm going to turn this over to the floor in a second for some questions. So the last question from me, and why don't we start with you, Henry? If an investor came to you and said, I want to increase allocation or build a collection, but I want to do it intelligently, what's the one piece of advice you would give them?
Well, I think the single biggest risk you take, beyond all the stuff that's going on in the world generally, is the issue of authenticity. So you have to be buying a genuine Van Gogh painting if you're buying a Van Gogh, because otherwise it's worth nothing. And therefore, the expertise, the knowledge, you need to get on board someone or a team, depending how broad your collecting is, that really understand what it is you're buying and can make sure that you're buying genuine works.
Okay. Leonie?
For me, it's really understanding what you're trying to buy and what role that will play in your portfolio, as that's really going to inform how much you're allocating, and what price you're comfortable buying it at.
Okay, and Spike.
So I think two mistakes made on India. One, my advice is don't buy an ETF because you're just buying a concentration of very overcrowded names, and they'll be the more expensive names. And secondly, don't try and invest in India from 8,000 miles away because you can't possibly understand what's going on the ground. So what I did was I found a team that had been on the ground with collectively more than 200 years experience, because you've got to have the best analysis, and being good analyst is only the first stage, because that's the qualifier. The differentiator is being a good judge of people, of businesses, of change, and you need a good team on the ground. So buying an ETF that just invests in a few large index names is not the way to do it. It might be in gold, but it definitely is in India.
I got time for a question from the floor. Mr. Cowie. Can we give him a microphone? Thank you very much.
Ian Cowie, Sunday Times. This is one for Spike. Until last year, none of the London-listed investment trusts focusing on India yielded any income at all. And towards the end of last year, JP Morgan's India fund aimed to distribute 4% of net asset value each year. And it's currently yielding about 5% because of the way the prices come down subsequently. Do you think we might see more India funds distributing income to investors?
I think the mindset really is that this is a growth story and people want to reinvest and compound. So it's not really been the traditional UK income story that we've seen here for the last 30 years. It really is a growth story. So I think companies that pay dividends is good, but for us, we'd rather compound them rather than distribute them. So I don't see that changing in the near term.
Ian, you run a portfolio. It's on the Sunday Times every week. You've been one of the leading journalists for the last 30 years. Always a great column. I just got a quick question for you. You going to increase your Indian allocation in your portfolio from what you've heard today? Thank you.
The last bit caught me out there. I have recently increased my exposure to India following the weakness in prices recently, because as Leonie pointed out, last year was pretty terrible for India, which is usually a good time to increase allocations to an emerging market. India Capital Growth is another investment trust I currently hold. JP Morgan's India fund will always be close to my heart because it was my very first 10-bagger.
Well done.
I think you two should have a chat later about a switch into the Cohesion Indian Equity Fund. I got a chance for one more question. Okay, Mr. Campbell Fleming. If you don't know who Campbell Fleming is, I'm just going to do a quick shout out. We hadn't staged any of this. One of the greatest leaders in the investment management industry in the last 2 decades. Campbell.
Thank you, Jamie. That wonderful compliment's returned, and it's a pleasure to be here. I'm going to ask Henry a question. So I was advising a company that tokenized art. It had a former, I think he may have been a colleague of yours sitting on the investment committee that valued the art. It spent about 3 years in operation. It was a structure regulated by the FCA, approved by Luxembourg, and the art was actually held in a bonded warehouse in Switzerland. It got absolutely no take-up. One of the issues that it was is that people were concerned about valuation, not so much at your house, but it's well documented that, shall we say, galleries and sometimes auction houses practices are not as consistent as what has to be done in Ian Cowie's example about investment trusts that have to be priced to the third significant decimal, or the ETFs that are priced daily and regulated on commercial exchanges and through processes. So unfortunately, I don't have 10 million to drop on a painting bowl, but if I did, I'd come and see you.
Come and see me, I'm here.
Thank you, Campbell.
So what do you suggest that we do? Because one of the issues here, I hate the word democratization of assets, but it's no doubt that anyone should have some impact investments, and we'll hear from John Bird later, some ETFs, some gold, and also that type of stuff, and definitely some art. So what would you say that could be done to bring the opportunity to investors to invest in the mainstream when they don't have 10 or 100,000 to invest?
I think that's a very pertinent question, and it's one that the art world will, I think, forever struggle with. The concept when two particularly aggressive people get into competition with each other, and they're damned if they're going to be beaten by the other guy. But today he's not feeling very well, so one of them doesn't turn up. The difference in price can be very substantial, and therefore putting an accurate valuation on something is basically impossible. And that, I think, is one of the fundamental problems with the whole concept of making art an investment, but particularly if you're fractionalizing it and doing something like an NFT or something like that, because there is no straight balance. I come back again to my point at the beginning, which is art gives you an awful lot more. So I think you sticking it away in some Swiss vault, your general public's not happy with that. The press hate it because the art is now taken out of people's ability to enjoy it and to study it and to look at it. Whereas most very wealthy collectors who have art are incredibly generous. They will loan, any academic needs to see a piece, come to my home, they'll give them lunch, you'll have a really nice time about it. So the whole concept of what art is, I think, needs to be considered very differently to the much more specific worlds that are sitting to my left.
Panelists, thank you very much. Can we just big it up for them? Well done.
Thank you, Jamie.
Thank you. Well done.